With that, I'd like to introduce Tom Sosnoff from tastytrade with why day trading is an important part of your path to wealth creation. Tom, it's all you.
Thanks so much. So, hi everybody, and crazy day in the markets today. So it's a fun day to be here with you. Of course, I'm here every day, so I guess nothing's really changing, or at least I'm sitting in front of the screen staring at the markets every day, and it's been that way for a long time. So, thanks for spending, thanks for spending an hour with us, or almost an hour with us today at the Nadex webinar, and I think it's gonna be fun because I get to do something that I don't always get to do at webinars. This is my first time speaking at a Nadex event. We just did the deal with IG a few months ago, and so it's a little bit, the world of binary options is a little bit new to me, but I'm learning just like you guys. And I guess the best way to describe myself, and I don't usually talk about day trading. Like I know that we're talking about day trading talking points. I usually don't get specific and talk about day trading, although I trade every single day. I just don't like the term day trading because day trading on its own has these, certain negative connotations, I think. At least that's the optics of it. The reality is I trade every single day, and I trade a lot every single day. And I do that because it's a big part of my life, and it's been that way now going on, or actually for 4 full decades. I started as a floor trader in the early 80s, 1981, and so it's been literally 40 years of essentially trading every single day. And even today, I probably make an average of, lately it's been a little busier than usual, but usually somewhere between, on the low side, 50 or 60 trades, on the high side, 120, 130 trades. Usually it averages around 80 or 90 trades a day. But yet I don't consider myself a day trader. That's the funny thing. Most of my positions are a combination of different scalps, a combination of different position trades, a combination of different products. I am, almost by definition, almost being forced to as a screen-based trader, I'm product indifferent. I'm also strategy indifferent. So I don't really care what I trade. I do care that I use multiple strategies, and I do care that there's certain characteristics that present themselves that I think define opportunity. And we're going to get into that a little bit today. But more importantly, for this segment, I'm going to be a little different than most. I know the last person was talking about technical analysis, and I will tell you right up front, I am not a technician. I don't use technical analysis. I don't use charts. I'm also not I'm not a macro or fundamental person in that I don't use fundamental analysis or news. I'm a screen-based trader that looks at markets to try to generate ideas from what's happening right in front of me. And when I say that, a lot of what we do is based on perceived price extreme, which is completely subjective or objective. A lot of what we do is based on implied volatility. Implied volatility is another word for, it's a measure of fear, and it's another word for expected move. And I'm going to show you all that today. The reason that I wanted to do this segment, besides the fact that I got to speak to a new audience and introduce ourselves to people that have never heard of me or Tasty or any of the stuff that we do, is that I'm a lifer. I'm a junkie in this business. I built the Thinkorswim platform. I built the tastytrade and tastyworks platform, and a bunch of assorted, institutional platforms and other pieces of software in this business. I've been in and around, since before they had essentially electronic markets. So we've been on the cutting edge of all this. So I've seen the industry develop, and I've seen what's happened as far as high frequency market making is going. I've seen what's happened to the industry as far as wealth creation. I've seen how fair and almost how literal the markets are. I've seen them grow organically, and I've seen the opportunity based on liquidity. So I think I can present a lot of that, or have discussions about a lot of that with you over the course of the next, we have a little less than an hour, so we'll have some fun with it. I think some of the key pieces to trading, and I'm going to get into this, and I'm going to, by the way, as we're doing this, I'm going to show you different aspects of our software, and I'm going to talk to you about markets so that I can put some context around the different discussion topics that we have. And in the process of doing that, I hope to give you lots of takeaways. I don't think people that give seminars or talk about webinars or whatever it is today, I don't think it's valuable if you don't constantly give takeaways, things that you can use. So I'll give you a ton of those, one every few minutes, hopefully, and things that you can actually put in your back pocket that you can use and that you can apply. I don't do anything institutional. I'm a pure retail, and I trade on the same exact platforms that you do, and I trade the exact same markets. So we're all in this kind of, together on a very level playing field. But I'll tell you why I think trading is so important, and I'll get into that with some of these talking points. So the single most important thing, and listen, I can't, because I'm doing the webinar and because I don't want to stare down at the chat box all the time, I'd rather give a more interesting discussion. If you have any questions that you want to send to me directly, I answer all my own emails. So just send me an email at tom@tastytrade.com. That's just tom@tastytrade.com. And I'm happy to answer anything you'd like. But on the chat right now is Brittany. She works with me. She can answer any Tasty emails, and we also can forward stuff over to our trade desk if we have any other questions. So let's talk first. The single most important thing about financial markets is that they encourage you to make quick decisions. And why are quick decisions so important? Because the way that we process, the way that things go from one side of our brain to the other, the way that we move through all the decision making we have in life, we just don't get a chance to accelerate the pace at which we make decisions unless we continually are making decisions. So why do I make 50 trades a day? Because that's 50 decisions with an emotional and a monetary outcome. And that if I kind of screw up on all those decisions, I don't last very long. And so the decision-making part of this, the decision-making tree, everything starts at decision-making, and then it works its way down to different levels. And the decision-making part of everything that we're going to talk about today is so important, because the faster that you can make decisions, the faster that you can assess risk, the faster that you can put, that you can add some kind of quantitative statistics to things that are going to happen. There's a big difference between what happens in the trading world and what happens in other places. And that's why the markets are so efficient and the playing field is so level in the world of finance, because we have models that are in place that basically price out what's going to happen to perfection about 70% of the time, which leaves 30% of the time as being very, let's call it wiggle roomish. And that is super cool because there's nothing else like that. And if you add very efficient pricing to very tight markets, what that means is, just to give you an example, if you were to compare financial markets to sports gambling, the size of the marketplace in sports is about 10%. The size of the marketplace in the fee structure in the financial markets is about 1/10%. So you're talking about a fraction of the amount of money to transact, to move in and out. We call that bid-ask differential. I'm going to go through all that kind of stuff with you today, but the key to this first slide, it's all about decision making. And the reason decision making is so important, because he or she who can make the fastest decisions always rises to the top. The best entrepreneurs in the world, the best business people, and the best traders are always the fastest and best decision makers. That's not something that's debatable. That's not something that's subjective. If you hang around, it takes you a long time to make a decision about something, it's very difficult to move to the next level. You know what drives me crazy? When people say, you know what, I'm going to take a step back and think about it. People that take a step back and think about it generally don't make good traders, but they generally don't make for very successful business people or successful entrepreneurs. I'm in the business of trying to create people that want to build wealth on their own, whether it's through entrepreneurship, through trading, through financial markets, whatever it is, and to encourage that through quick decision making. Unfortunately, there's not that many places where you can make a lot of decisions and yet risk a little bit of money. That's the challenge. So what we're going to do is, let's go to the next slide. And we're going to talk about immediate risk assessment. And then I'm going to take you over to the trading platform and just show you what immediate risk assessment is. So just on a, if you were to look at something and anything, and you were to put, let's just say you were to look at a plant in a store, or you were to look at a car at a car dealership, or you were to look at a house in somewhere on a lake, or whatever else it is, or the cost of a trip or anything else, you'd probably wonder, how does somebody come up with this price? How do we really get to this price? Is it completely arbitrary? And in most of the world, price is really arbitrary. But in the world of finance, because we're all watching the same movie and we're all trading essentially the same products under the same conditions with the same fee structure, price is not something that's very subjective. Price is something, when I say price, I'm talking about like how a derivative is priced. So derivatives are priced based on a model that takes a lot of variables into account, which ultimately, and I'm going to show you this in a couple seconds, sets you up to know almost exactly what the expected move is going to be, and what the risk is around that trade, and what the different strategies are that you can do. So the beautiful thing about financial markets is that you can make an immediate risk assessment. You really can't do that anywhere else. You can't make immediate risk assessment on a piece of real estate. You can't make an immediate risk assessment on a collectible, for example. I mean, until there was an NFT market, you really couldn't do that. In the world of decentralization, a lot of this is going to change. But for now, the ability to make an immediate risk assessment, which means that risk assessment is in effect tradable, is what makes trading so interesting, because there is no other marketplace like that. So for starters, there's no other marketplace where you can make quick decisions, improve the speed at which your brain processes decision making, and at the same time analyze the risk around those decisions that you're making and put context around that risk. So what I'm going to do here, let me just see. Hold on 1 second. Perfect. Okay, what you should see in front of you now is the Tastyworks platform. And I'm not going to take you through, I'm not going to torture you with a whole software demo and everything else. But what I am going to do today is try to get you into a mindset where you can accept that, hey, now I understand what he's talking about with respect to product indifference. Now I understand what he's talking about with respect to different things. Because what is so interesting about what we do, and hang on, let me just see now, just to show you, I'm a junkie, so throw orders in every once in a while. That's a future. But in the world of trading, what you see here on this screen is all futures, and what you see down here are all stocks. And these are what we call futures, and stocks are what we call static financial instruments, meaning if you buy them, you want them to go higher. If you sell them or sell them short, you want them to go lower, okay? But they're static. They're not strategic in that sense. Futures and options and crypto, for that matter, all three of those asset classes are what we call static. Now, if we want to go into a derivative like options on stocks and options on futures, those are what we call dynamic, because you can be right and you can lose money, or you can be wrong and you can potentially make money. And to a lot of people, that's fascinating. But what I wanted to show you, which is, I think, such a key element of just kind of everything that I'm talking about, is what I wanted to show you is that from a single platform today, because the first slide I started out with was talking about making decisions. And what I want to show you is just how crazy tight these markets are. And I'm going to give you an example first in the S&Ps, because this is the most liquid marketplace in the world. And if you follow my cursor up here, the S&Ps, they're up 94 handles. Now, just to put 94 handles in perspective, that's over a 2% move. That's way outside of the expected move for one day. And I'm going to show you what's so interesting about that is the expected move for one day, and you can see it here with 19% volatility, in this case was about $32, and it's moved $95. So the market's moved about 3 times the expected move in one day. This is just one daily expiration. Normally it's a little bit, it's a little bit bigger than that. But so today is kind of a crazy day in the markets. That's my point. But what's so neat about this is this marketplace here is 1 tick wide. That 1 tick wide marketplace in the most liquid future in the world is $12.50 wide. That's all it is, $12.50. So if I was to buy the offer and sell the bid, okay, I'm going to lose $12.50. Or if I'm going to sell the offer, if I'm going to sell the bid and buy the offer, I'm going to lose $12.50. Now, obviously, my game plan is not to lose money, but the reason I'm explaining this is because with a single click and $12.50 in bid-ask differential plus $1, whatever, $1.25 in commissions, you actually can control the equivalent of this product right here, which is $50 times 4,600, which is the equivalent of $230,000 worth of S&P stock. So for $230,000 worth of S&P stock, the bid-ask differential is $12.50. Just put that into context for a second. So the reason that trading is so important, and I think it's so important to anybody's personal ecosystem. Like I look at myself as my own kind of money manager, my own portfolio manager, whatever you want to say. And I look at that ecosystem of different investments I have, maybe real estate, maybe some small, venture deals I've done, or maybe some businesses, whatever it is. But I look at my ability to transact, my ability to create opportunity. And where else can you control $230,000 with a $12 bid-ask differential? So if you went out to buy a $230,000 condo, let's just say, and the commissions, negotiated commissions, were if we're lucky, let's just say 5%. It's probably higher, much higher than that, 6% or higher than that. But let's just say it was 5%, and you did a $230,000 condo. You'd be paying on 5%. You'd be paying whatever, almost $12,000, and that's $12,000 in. That's $12,000 out. Essentially, on both sides, somebody's paying. So that's $24,000. In this case, it's $25. Just process those numbers for a second, because it's crazy. So on one way, buying or selling, you're paying $12,500. In this case, I'm paying $12.50. That's why financial markets are so cool. So for example, if I went out and I just bought the offer and I sold the bid, that whole process, I just lost $12.50 and I moved around $230,000 worth of capital, and that's real money. But then the beauty of this, and this is what I meant by you can make lots of trades. The beauty of this is I can go over to some stock, like let's just say Microsoft as an example, okay? And just as a trader, I put Microsoft on the top line. And the markets in Microsoft are pretty tight. And let's just say I wanted to buy 100 shares of Microsoft. So I'll put a bid in, I'll bid 97 right here. And that's my bid. Now it's even bid. So I put my bid in to buy it. I didn't get filled. Now I'm going to go, actually, let me do this, because I want to show you both sides. If I was to buy or sell stock, I can buy or sell stock all day long in here, either way. Now, I bought it. There you go. Filled both sides. So I just scalped 4 cents or $4 on 100 shares. So I bought and sold 100 shares. I'll show it to you right over here. Sold 100 at 01, bought 100 at 97. So that's 4 cents. That's $4 on 100 shares. The only reason I show that to you is that basically I can buy and sell 100 shares of Microsoft. Microsoft is a $335 stock. So 100 shares is $33,500. And I can buy or sell that with 0 commissions, because they're commission-free stocks. And I can buy or sell that, and the bid-ask differential is 1 penny. and I'm moving around $35,000 in and out. So when we talk about the ability to make trades, the ability to make decisions, to have some form of, you push a button, you have an emotional outcome, you have a monetary outcome, and that's just a futures market and a stock market. Now, for example, if I wanted to go to something else and I wanted to trade, because I think it's important that you see all this, and I went to the spiders and I went to, I don't know, options that are expiring in a couple of, in 10 days here. And I went to an out of the money option and I said, let's see, I'm going to sell, let me just do a one lot just to show you. I'm going to hit the bid, and I sold that, I sold the 475 call, and I'm going to buy it back. And that cost me $1 to sell the bid and buy the offer. And what I did was I just bought and sold an out of the money option, which controls 100 shares of stock, which is a $468 stock, which has a notional equivalent of, let's say, $46,000, but in reality, it's a little bit less if you convert it to actual shares. But my point is, for $1, you can move in and out of an option which controls 100 shares, to be strategic about it. And the bid-ask differential is $1. So when I posted the first slide and I said, hey, the coolest thing about trading is you can make lots of decisions, we just made lots of decisions. And we did it in the futures market, in the stock market, in the option market, and now we're just going to have some fun. And for example, we're going to go over to the crypto market, and I'm just going to pick a cryptocurrency. I'll use Ethereum right here, and I'll buy $100 worth, and then I'll sell $100 worth, and my give up on that trade was about 12 cents, buying and selling. Now, again, I did this only as an example of why it's so important to understand product indifference and your opportunity to make as many trades as possible to get yourself into the mindset where you're a decision maker and you're not a follower. Listen, we're not analysts. We're not sitting here. We're not technicians. We don't believe in macro or fundamental or any of that kind of stuff, because it's all, in my opinion, it's all bullshit. It's all, in my opinion, it's all about, you're relying on something that isn't really there. I'm an efficient market theorist. I believe price is always accurate. So our goal is to create opportunity through strategy and to create opportunity through understanding what's going on. So in front of you, you've got this amazing technology, whether it's Nadex technology, whether it's Tasty technology, it doesn't make any difference. Point is, you can trade in any marketplace, virtually any time, as long as the markets are tight, as long as the markets are liquid. You can make a ton of decisions, and the more decisions you make, the faster your brain processes future decisions. The difference with most athletes that separate really great athletes from just really talented athletes that never are that great, it's just their ability to make decisions. Smarts, whatever you want to say, but it's mostly the ability to make decisions. There's a reason why quarterbacks in the NFL that don't have the same physical skills, like the Tom Brady's of the world or the Aaron Rodgers of the world, that don't have the same physical skills because they're older, but they're still at the top of the league as far as production is concerned. They're still among the best in the business. Is because they have better brain processing speed than anybody else. They make decisions, they see things that other people can't see. The world of finance is no different. It's your ability to make decisions, and that was the first slide. And the second slide, it showed you that it was about being able to assess risk at the same time. So, I brought up a bunch of different underlyings, but now let's continue down in the world of other crazy underlyings. So let's go to NVDA, just for the hell of it. So NVIDIA is an underlying that it's been pretty crazy over the course of the year. It's up $20 today, but I don't know where NVIDIA is going next, and actually I don't care. I just know that NVIDIA has an implied volatility rank of 57, which means that the options in there are very richly priced, and because they're richly priced, I also know. I should start here. Also know it has huge volume. 37 million shares are traded today. So it's a tight market on a $300 stock with high implied volatility and great liquidity. But then by just looking on a platform like Tasty, I can go over to the right-hand column and I can say, hey, you know what? In November, the expected move is $42. That number is going to be accurate about 70% of the time, because it's inside of the distribution curve, whatever, 68.6. And then that's inside of that one standard deviation, that distribution curve. And so what we can do is, if we want to create a strategy, we don't have to say, what if NVIDIA goes up? What if NVIDIA goes up by $100? Or what if NVIDIA goes up by only $10? You don't think you know what's going to happen. Well, the market's pricing out for you already. It's saying, hey, over the course of the next 45 days, the expected move in this stock is about $42. And so you can set up whatever strategy you want around that $42 level. That's what we talk about when we talk about risk assessment. So if you're bearish in NVIDIA, you can go $42 above the marketplace and sell something. If you're bearish and you want to buy something on the put side, at least you have a perfect exit point that is priced by the way the options are pricing everything. That's what we call context. That's risk assessment. That's not subjective. That's not speculative. That's real. Those are the numbers that everybody else bases everything on. Those are the numbers that somebody, you got to remember this, those are the numbers that somebody out there right now is willing to basically put their career on the line, because they're making this market one penny wide based on those numbers. That's why it's so real. You go buy a car, you're not really sure what the market is for that car, either if it's a used car or if it's a new car, because you're not sure how much the dealer is marking up into it, in or out, whatever it is. When they buy a car from you, you're not sure how much lower than the real market they're giving you. When you sell a car, you have no idea. I'm sorry, when you buy a car from them, you have no idea, how much over you're paying. But in the world of finance, it's perfect. Every time it's perfect. There are no mispricing. That's the beauty of this. Nothing is mispriced. Doesn't mean things can't go higher or lower. It just means nothing is mispriced. So what we're going to do is I'm going to go back to the PowerPoint slideshow from the beginning. Perfect. Sorry, I wish I knew a better way to do this. Okay. And so the next slide is about, I'm going to talk to you about accelerating your processing speed. And it's so important to me, because what I've learned over the years, I'm going to tell you a quick little story. When I first got to the trading floor, this is in the early 80s, I had no idea what was going on in this world, in the whole world of finance. Just people yelling and screaming, lots of open outcry, and just tons of noise. I thought it was the coolest place in the world, but I had no idea what was happening. And I was talking to this kid that I met playing basketball, and we were just kind of, just talking it up. And he said, there's a guy in the pit that you're standing in that's amazing. Just do whatever he does. And I'm like, I said, well, I don't even understand what he's doing. He goes, well, just try to figure it out. And so I sat there for a couple of days and just watched this one guy. And what I noticed, which I didn't know before this person said that to me, was, oh my God, he's so much quicker than everybody else. He's so much faster. He can, in his head, the numbers, he obviously can visualize numbers and fractions. This is before decimalization, faster than anybody else. Well, fast forward about 40 years of my life through multiple, we've built multiple billion-dollar businesses, and I've gone through a lot of different things in my life. And over the years, the most incredible people that I've met make the fastest decisions. We had a guy on our board. He's not a trader, but he's an incredibly fast decision maker. And the longest I've ever seen him take to make a decision on anything, whether it's $20 or $20 million, is about 2 or 3 seconds. And he makes his final decision. And I'm like, I said to him once, I go, you'd make a great trader because you're the fastest decision maker I've ever seen. And he goes, you're not the first person that ever told me that. I'm not that I make a great trader, but that I'm a fast decision maker. And I go, it's unbelievable. It's just, we always used to joke, if you can order a hot dog really fast, or you can order a pizza, you can trade. And I think there's a lot to it. But the problem is, oops, you know what, I didn't want to go, hang on one second. I don't know how to go backwards on this thing. I apologize for this. Let me do this from the beginning. Yeah, so accelerating your brain processing speed, and I've been talking about this a lot because the whole reason I wanted to give this discussion today on trading and talk about day trading, and again, the product itself doesn't matter to me, it's the concept. And the reason I want to talk about it is because there's a huge part of trading that's been overlooked for decades. Now, go back a couple of decades and you couldn't do this because the fee structure was too high and the technology stunk. But today, the fee structure is basically zero and the technology is amazing. Like the Tastyworks technology is all high frequency technology, which means front to back, the whole middleware piece is about like 18 milliseconds. It's, it's quicker than a blink of an eye. Legacy technology, like a lot of other older firms, may still be like 600 or 700 or 800 milliseconds. But the new technology that we push out today, it's literally less than 25 milliseconds. It's crazy. So what happens is you have this amazing speed, you have virtually no fees, and you have these incredibly tight markets, like I showed you before. There's no reason to be product indifferent. If you ever hear somebody say, oh, I only trade this, then they're not a trader. If you hear somebody say, I only trade this strategy, then they're not a trader. Because in order to be successful, you need to trade multiple products, you need to be diversified in the underlyings that you're trading, and you need to use multiple strategies to really give yourself, true non-correlated risk. So if you combine all that as you speed up your ability to, process decision-making. Listen, we've had plenty of customers over the years, plenty, where trading's not for them. We always talk about it in the terms of a distribution curve. And in the world of distribution curves, let's just say 70% of the people fall somewhere in the middle. And of that 70% that fall in the middle, 35% are usually successful and 35%, fall below the average line and 35% fall above the average line. It's pretty straightforward. But on the outside of that distribution curve, there's about 15 or 16% that knock it out of the park. And there's also about 15 or 16% that don't make it. So if you wanted to know the real odds, there's about 15 or 16% of everybody listening today, you're going to do really well and way outperform your peer group. 15 or 16% not going to make it at all. And everybody else is going to be either above or below that line in the middle, in that general distribution in the middle. So on the positive side of that line, it's almost 50, 51%. The negative side of that line, it's also 50 or 51%. That's a real, true, efficient market. But the stuff that we're talking about today gives you what I call a mechanical edge, not a theoretical edge, not a mathematical edge, just a mechanical edge. And a mechanical edge means it's just a strategic edge. It's like understanding certain things. There's takeaways in there that make you do things. The more you do something, the better you're going to be at it. Which is why it always drove me crazy when people talk about trading. They say, well, don't overtrade. Yeah, 30 years ago, you shouldn't overtrade because the commissions were too high. Today, everybody should overtrade because it's the only way to get better. It's the only way to learn everything. It's the only way to really be able to absorb, hey, this is what I need to do. And at the same time, keep your size really small. So you keep your size low, you keep your size tiny, you stay in liquid underlyings, you learn about product indifference, and then at the same time you constantly accelerate brain speed, you are going to be much better at this game than everybody else. In the process of doing that, we are going to learn how to dissect, discuss, and articulate financial markets, because part of that socialization is so important to getting to the next level. It's one thing to try to do it on your own. And listen, everybody that's on today is smart. This is not a game where they're lacking for really smart people. Most people that are listening today are self-employed, or they're engineers, or they have, advanced degrees. This is not, I'm not dumbing this down at all. But the ability to dissect complex financial strategies, not markets. Because dissecting complex financial markets is kind of bull. There's meaning that I don't believe anybody knows anything compared to anybody else. I don't believe that there's any edge in what we call analytical knowledge. There's edge in quantitative mechanics. There's edge in understanding the statistical significance of things. But I don't believe there's any edge because you think you know more about the news or you're a better macro player than the next person. So your ability to dissect strategies, your ability to discuss those strategies with other people, and your ability to articulate financial markets, it's a game changer. Not only if you're young, it may open up doors. If you're older, it may open up just a different way of thinking. You can't believe how many people are so scared of the world of finance because they've never had an opportunity to dip their toe in the water, or toes in the water, or fingers, whatever it is. So learning how to articulate things is a big part of the battle of being successful. Once you can articulate things, it's amazing how much you learn from that. And when you're able to communicate and you're able to actually ask the right questions and you're able to discuss what you're doing with other people, it's a very powerful thing because you start to realize and you build confidence. You're like, hey, you know what? I kind of thought maybe I wasn't getting this or I was a dummy or something, but you know what? I freaking know this, man. I'm smart. I know this stuff cold, and it really helps. And confidence is a big piece. So again, the ability to dissect, to discuss, and I always talk about it as articulating financial markets is so critical. Very few people, I mean, outside of the people that are on this, on this webinar today, or maybe the few, we've probably turned maybe 1 million people onto finance over the last 20 years, and maybe the 100 or 200,000 tasty traders out there. Sure, you guys hear this story all the time. I mean, I don't shut up about it. But for everybody else, which is about 50 to 70 million people, they have no idea what we're talking about. And, listen, the ability to articulate something has an incredible value because, again, it's another piece that complements your ability to make faster decisions and to assess risk faster and to improve brain processing speed. It's all part of the same equation. Then, hang on. So, and this is what I'm going to take you back to the software in a couple seconds on, which is to learn about tradable products and very different strategies. So the bottom line to all this is, okay, this all sounds great, but I'm a customer of Goldman Sachs. How do I do this? You can't. They don't have any customer-facing technology. Okay, well, I'm a customer of Morgan Stanley. How do I do this? They don't have any customer-facing technology, unless you count E-Trade, but I don't even count that. And what if you're a JP Morgan customer? Oh yeah, they don't have that either. So the largest financial institutions in the world, they don't have that stuff. Okay, these are for what we call, this is fintech, and this is the new age from challenger banks and neobanks down to online boutique brokerage firms. This is not app-based stuff like, for example, like Robinhood or things like that, where it's essentially black and white, totally static. It's not dynamic and it's not strategic. That's not what we do. We love to talk about things where the products are tradable and the strategies are tradable. The only platform in the world that supports all products and all listed products and all strategies is Tastyworks. Now you're going to think, oh, that's crazy. There's got to be other platforms. There are not. At this point in time, the only platform that supports all strategies and all products that are listed in the US is Tasty. Let's go to the next slide. Let's take a look. So people say, well, I have somebody that I work with. I have an advisor, or it's too complicated for me. I much prefer traditional portfolio management. This is a complement to it. It is absolutely ridiculous under any circumstances for anybody to say, hey, you know what? This is outside of my scope. I mean, yeah, some people don't have time for for certain things. I get that. Sure, no problem. You know what? But one of the things that we've done in years past is we have not committed to the world of finance at an early age. So we've waited till we've got older. I always say, next thing you know, you're 50. Next thing you know, you're 60. You close your eyes when you're 25. You wake up, you're 55 or 60, and you're like, where the hell did my life go? And how come I don't know anything about finance? And so what we do is I want to complement traditional portfolio management with active trading, because the benefits of active trading far outweigh the benefits of traditional portfolio management. If you believe, like I do, that nobody knows what's necessarily going to happen next, then the problem with traditional portfolio management is you learn nothing. If somebody else is doing it for you, you learn less than nothing. But if you do something for yourself, you learn everything. So what I'm going to do now is minimize this screen, and I'm going to take you back to the technology, and we're going to talk about certain things, because in my eyes, there's a lot of things going on around the world that are really interesting. You might say, well, what's so interesting, Tom? I mean, in the last week, you know, the variant, you know, we've been in for the last year, and well, we're going in a couple of months. We'll be going on 2 years. So let's say for the last 20 months, we've been dealing with something that we've never dealt with before, which is a biological pandemic or a biological binary event. Who's to say in the future we might not be dealing with other things that we've never dealt with before? It's highly likely. I'm not talking about, doesn't necessarily have to be biological, but it could be something else. Point being is, the only place where you can measure your skills, and you can either be scared by it or you can take advantage of it through the opportunity created in the marketplace. Those are the two options you have. And we've always been, you know, turned on by the ability to take advantage of the opportunities presented by different situations. Stock I have on the screen here is Baidu. Another stock that we trade a lot of is Alibaba. These are both stocks that have been destroyed as the Chinese government has gone through kind of, let's call it a redistribution process of a redistribution of tech wealth in China, and they've destroyed stock prices. Alibaba was at one point close to, I want to say close to $400. Let's see. I'm not even going back far enough, but it was right here. It was 270. It's 100. The stock's been cut by, I'm guessing, you know, almost 70%. So you might look at this and say, hey, you know what? When I say I'm not a technician, I'm not. I don't use charts at all, except to say, hey, where's the stock been and where's it now? But when you look at a stock like Alibaba, I think to myself, okay, you know, I'm looking at the tale of two different worlds right now. I'm looking at Alibaba, which has gone from 350, let's say, down to $130. And it's a powerful tech company. Yet it's been subject to, you know, intense regulation from the Chinese government. And yet, on the other hand, I'm looking at similar like companies in the US that are at all-time highs, whether it be, you know, Amazon or Google, whatever you want to say. You know, you can pick the biggest monopolistic tech stocks or tech monopolies in the US, and they're all multi-trillion-dollar numbers. There was a point when somebody had said, well, Alibaba is going to be bigger than Amazon, or Alibaba is going to be bigger than, you know, whatever, Facebook or something else. And now it's just a fraction of the size. What's interesting is you can look at that and say, wow, that's crazy. Or you can look at it and say, wow, that's opportunity. And that's not looking at something macro-like, that's just looking at price divergence. And that's looking at price divergence and as a natural contrarian and saying, hey, you know what? Maybe there's something here to take advantage of. Maybe there's not, but at least I have the opportunity to do it now. Maybe I'm looking at, and that's, for example, that's something like, you know, Alibaba versus, just to give you like a little fun little look here, just because you're going to be shocked by this. Let's just say I bought Baba and I sold Amazon. This is a little pairs trading vehicle that we have. And I'll pop up this screen, make it a little bigger for you. This is where this trade got down to, you know, basically just before the last couple of days. And oh, you know what? I take this back. This is, yeah, this is a very short-term chart. I'm not going to waste time changing it right now. But this trade got grossly oversold. Can't tell from this. Amazon's basically at highs, Alibaba's basically at lows. It's a grossly oversold, we call pairs trade. And that's, you might say, hey, you know what? That's interesting. I will sell puts in Alibaba. I'll sell call spreads in Amazon. It's a capital efficient way. Or I'll sell put spreads in Alibaba. I'll sell call spreads in Amazon. And that's a very capital efficient way of doing a customized or bastardized iron condor. Define risk trade, take advantage of China potentially going higher, or the US markets potentially going lower. But maybe that's not interesting to you. So maybe you say, hey, you know what? What is interesting to me is the divergence between natural gas and crude oil. In the last week, or last couple of days, crude oil is up $10. Natural gas is, let's just say by percentages. Crude oil is up over 10%. Natural gas is down 20%. That's interesting. Or the yield curve. Most people don't know how to trade the yield curve, but the yield curve is the lowest it's ever been. That's the short-term rates over long-term rates. And you can trade all these products once you have some know-how or the ability to just even talk about or articulate, financial markets, which most retail investors just don't have. And this stuff is so interesting. Or you can just say, hey, you know what? We've had an incredible move in, let's pick out, let's potentially pick, I can use a biotech stock, or let's just use a stock market instrument like the Russell, for example. So the Russell's up another $6 today, but the Russell has underperformed relative to the NASDAQ and relative to the S&Ps. And let's just say you said, hey, you know what? I'm not necessarily bullish on the NASDAQ. I'm not necessarily bearish on the NASDAQ, but I just want to sell some premium. I just want to take advantage of this incredibly high implied volatility, because volatility on volatility, even though it's in today, even though it's in yesterday, it's still 20% higher than its historical averages. And so I think there's a lot of juice in there. And the cool thing about this kind of platform is you can open up an option chain and do whatever you want to do. Here, the expected move over the course of next month is $15. The current stock is trading at $225. So if I go $15 away on the put side, I can sell the 210 put, and if I go $15 away on the call side, I can sell the 240 call. Collect $5.20, equidistant away. And I'm not saying that's the trade I necessarily want to make. I'm just pointing that out as a trade that somebody might say, hey, you know what? I like that. I collect $5 in decay, or $500. I'm only putting up to make this trade about $3,000 in total capital to do a one lot, and I can make $500. And so for a 45-day trade, that is a very interesting return for 45 days, making $500 on a $3,000 trade. The statistics there, it makes it interesting. If you annualize that, it's almost 100% return. But on a, if you annualize that, yeah, it's about 100% return. But if you just look at it from 45 days out, hey, it's interesting. With an extremely high probability of success, because remember, your probability of success in this trade is going to be over 70%. I just bring these kind of things up because people are thinking, like, why should I necessarily do something that's a 50-50 shot when I can do something with a 70% probability of success and a nice return on capital, and I just have to, potentially manage the trade? It's strategic. I'm not bringing this up because I'm suggesting that as a potential strategy for you right now. I'm bringing this up because I think it's so important for people that haven't heard the story before to understand why trading in 2021 is such an important part of your personal ecosystem, because prior to this year and prior to the last year or so, the technology maybe wasn't there, the fee structure maybe wasn't there, the liquidity in the marketplaces maybe wasn't there the same way it is today. Today, every market is basically one tick wide. The fees are non-existent, and you can trade whatever you want from a single platform, and you can do whatever strategy you want. So you can be product agnostic, strategy agnostic, and you can do, virtually anything with your capital in any marketplace. almost 24 hours a day, 7 days a week. Crypto trades 24/7. And as we go to tokenization over the next couple of years and everything becomes tokenized, everything's going to go to that. The world of decentralization is coming on a massive scale, and the listed marketplaces will prevail, and they'll be the primary marketplace for derivatives. But as soon as there's clarity in the decentralized space, we're going to 24 hours a day. And not learning this stuff or not understanding it, you just heard, you're just putting yourself a little bit behind. Okay, I've talked for 53 minutes straight. I'm sure everybody needs a break. That was fun.
Yeah, Tom, thank you so much for that. Personally, I love how you talk about how the markets are fair, the financial markets are fair, and you talk about how, there's liquidity, there's a bid and there's an offer, and you mentioned the used car. I know a lot of people say, you take a used car, you buy a car as soon as you go off the lot, it depreciates in value. The example I've always used is, you go to the butcher, buy your meat, and then if you don't use all of it, good luck going back to the butcher and trying to sell your used meat back to the butcher. It's just not going to happen. But in the financial, in the financial markets, there's liquidity both ways. You can always unwind or go a different way, and you're getting a fair price because you see the price someone is willing to pay on the other side or to sell it on the other side. And it is important, if you want to build wealth, being able to trade and get into the markets. And if we go to 24 hours a day, it's only going to get that much more fun.